The Dow up triple digits. Its first gain in 3 days. We're up 172, guys. I say that a little bit tongue-in-cheek, John, because you know what I mean. China has said they've been open to a partial deal for a long time. I don't know why the market is reacting on the news other than maybe it came from China.
Yeah, that is exactly why, Brian, because it came from China and instead of the president tweeting about it. That's one of the big positives there. And, of course, we had the Fed yesterday that announced QE4 is coming our way. And when you've got QE4 coming, you know, don't fight the Fed. I think anybody who was into that big sell-off yesterday, kudos to you for catching it, folks. But if you didn't get out of that short position, you're not doing so well today.
Okay, but Michael, we were told yesterday by Mr. Jerome Powell that while this is definitely quantitative easing, whatever you do, don't call it quantitative easing because that's not what it is, even though that's what it is.
Isn't that great? And so that made it really clear for everybody, sure. I think. What you need to know is that the Fed is going to be there and do more. All that you need to know.
They got your back. They got your market back.
Well, if they can, actually, because, you know, Mohamed El-Erian wrote just a couple of weeks ago that the Fed's kind of pushing on a string, as are a lot of other central banks. I mean, what businesses are going to take action just because they can borrow money at 1.5 as opposed to 1 3/4? Is that really going to create economic activity? El-Erian said we needed a coordinated fiscal policy effort. I think the Treasury Department needs to pay attention.
I think John hits on the important note, and that is the Fed, and it is the liquidity. And think about it. We had Chris Whalen sat right here on with you and I, talked about the need for liquidity. It's the end of the year. The big five banks, they have to have that capital on their balance sheet, so they're going to create the liquidity trap. That's the environment we were in last year. So if you're sitting back and you're telling me, looks like Q4 2018 all over again, well, I'll tell you what's different this time. You have not a hostile Fed, but a friendly Fed that is giving you liquidity versus last year taking it away.
Joe, do you remember that now infamous Steven Mnuchin letter of, I don't know, whatever it was, about a year ago, where he was like, I called the bank CEOs and everything's fine.
Sure.
And everybody woke up and goes, why is he calling the bank CEOs? Yeah. What's wrong? Yeah. When I saw Powell's comments at first, my first thought was, why do they need to reassure us about liquidity?
They're going to have to do that every year as long as these big five banks are going to be required to keep the amount of capital on their balance sheets that they are being required because of the regulations. Right. So it's going to be a condition that's going to be with us every year. But at least this year, let's not use liquidity as an excuse, because the Federal Reserve, and John's right, call it whatever you want, QE2, 3, 4, 7, whatever number you want to assign to it, it's liquidity that's being added to the system. And it's good for risk assets.
It is liquidity. I've got to push back a little bit on calling it QE. I don't think that's a fair representation. And I think that, so our chief economist, Luke Tilley, calls it, he made a very good analogy the other day. The economy is an engine, right? And it needs oil or liquidity to keep it moving. And as
gasoline.
As that engine grows, you need more liquidity. So QE and the balance sheet expansion was an experiment on the way up. It was an experiment on the way down in terms of tightening and reducing that balance sheet. They have to kind of right size it now and get it to more of a normal growth level, which is what they're doing. So they're expanding, but it's part of the normal growth of the money supply and the economy.
But then I'll push back on your pushback. Then we should get Luke on here, by the way. Doesn't that imply, if you've got to right size it, that you were wrong sized at some point?
Well, I think what we've heard from the Fed is that it's part of they don't call it an experiment, but it's part of kind of getting that equation right. And so they knew that at some point they'd have to expand the balance sheet back to not QE, again, because it's important what duration, what securities they're buying. This is more like adding that normal liquidity to keep the repo market functioning.
All right, so now that we've broken down the engine.
I disagree with what you guys are saying, so let me jump in.
Who do you disagree with? Because she disagreed with me, and I disagreed with Luke.
I'll disagree with the whole thing. Yesterday we were up and we lost. How many points did we lose? And it didn't happen when the Fed was talking. It happened when? When we started to hear about visa restrictions, investment restrictions, and the Chinese coming after us, right? That's when we went down. 90 minutes later, we're 250 points lower than we were, right? So what have we recovered today? Well, the Chinese say they want to do some trade. Hey, maybe there's going to be something going on. It might not be a great deal, might not be a big deal, but it'll be some kind of a deal. That's why the markets are up today. That's why we sold off yesterday. The Fed was already out there. We already had heard from Jerome Powell.
But
the market was here. I still think that
this is headline.
This is 80% about the trade war, Brian.
Well, the day that somebody in China apparently said they're willing to do maybe a partial deal, kind of, they ban all NBA licensing, kill all streaming from the NBA.
Very much like we are. Tariffs on everything.
It's like we want to make a deal, and then we create this.
And take a look at volatility. What happened to the volatility yesterday?
Can you sit there and say that we're closer now to a trade deal than we were 24 hours ago?
I'm not saying that.
But
they're the ones that were saying
the market's saying.
The market's saying that because of the fact of what they heard from the Chinese. So the market is reacting. It's the usual headline reaction from the.
The market's cheering that it hasn't blown up after what could be seen as a very severe escalation in tensions.
They haven't
over
flown
the past
out of
week.
Dulles, right?
But
they're not in a flight going home.
I agree with Pete that the market's going to continue to trade on the trade headlines, and I would caution against doing that. I think trying to position around these trade headlines is like playing hot potato with a grenade.
Well, Meghan, as usual, you are exactly right, because during Worldwide Exchange, 5 a.m. Eastern time, fine show, by the way.
God, that's right.
We saw futures go from 80 points up to 250 points up in 5 minutes this morning on that headline.
What? Oh.
I'm not saying the markets aren't moving on the headline, Pete. What I'm saying is, should they be moving on the headlines when I'm not sure what's new in there, Meghan?
I don't think we're getting that much new. Again, it's the fact that it hasn't blown up at this point. But I think that what is important at this point is getting some of those tariffs to start coming off. And I mean, what do you do with this? So we've been neutral equities for a while. We reduced risk in May, and we're kind of being patient at this point.
What does that mean in English, reduce risk?
That means we took our equities from an overweight for several years to neutral, which was a big step to us. So versus our benchmark, we have the same weight in equities as the benchmark. And at this point, we're kind of, you have to just wait. You have to be patient. It's not that satisfying to be hanging out kind of in the middle, but that's probably the best thing to do. And there's areas in the market that you couldn't be taking opportunities, whether it's within more of those protectionist playbook type of ideas. We talked about off-price retail, higher quality, minimum volatility, or more of a sectoral growth story. So we talk about the growth of 5G, and there's, tower, REITs, and other 5G infrastructure plays where you couldn't be maybe taking a longer investment horizon. It's not necessarily going to protect in a downturn, but if you have that multi-cycle horizon, you could do well.
I would observe we're trying to find an answer as to why the market goes higher, and we have all these conditions. So Pete's talking about the Chinese headlines, whether they're good or bad. I'm talking about the Federal Reserve. You could have a debate on either side, and the narrative seems to change every day. You could even have that debate surrounding where earnings are going to be placed. I would just observe, it seems to me that equities are a coiled spring. It seems as though any time there's the appearance of some form of visibility, they want to move higher. They want to trend higher. And that's been the trend for the entire year. And I think there's this demand, both domestic and international, that people want to be investing in global assets, specifically in equities. And I think that's kind of the message that's being telegraphed here. If we could get past a lot of these negative headlines, I think sentiment is a little bit depressed.